So what would you do if you came across an inheritance of $100,000? The answer is going to be different for everybody, but you know what? We get clients that come across this situation all the time. Now, it's not always an inheritance. Sometimes it's they sold a piece of property and they got a windfall of capital. So let's just eliminate the source of the money, but you receive a windfall of money and you want that money to go to work for you. So there's lots of options. You could put it in high yield savings. You could put it into an investment account. I certainly wouldn't do that right now. Or you could put that money into a specially designed whole life so that you make money twice on the same dollar. So which one of those would you prefer? Well, most of our clients want to make money twice on the same dollar, but there's some problems with that. That's not as easy as it sounds. You can't just take a lump sum of money, and in this particular example, we're just going to use a round $100,000 number. It could be $1 million, it could be $10 million, just $100,000 is the example we're going to use. So you got that money, you can't just dump that money into a specially designed and engineered whole life because you would create a MEC, a modified endowment. So what I wanted to do in today's video is show you two strategies, but I wanted to boil it down to the mathematics. Does it make sense to take a lump sum and just put it all into a policy and just call it a day? Because a lot of people, they have the money, but they don't want to save anything after that. They just want to put that money into a place, let it work for them, and be done with it, right? So that's what we're going to do. I'm going to show you how to do that, two different strategies, the mathematics behind it, and the end output that you would get. So let's dive in. So let's begin this journey with, well, a real example. So we actually had a client not long ago who had a windfall of $100,000 from the sale of one of their real estate properties. And what they wanted to do is they wanted to take that money and put it into a policy, but they didn't want to do any future premium deposits. So this is actually a case study, but I'm just going to keep it very general. So we came up with two strategies. Number one, we wanted that client to make the most amount of money, but yet keep the most amount of liquidity. So the first thing we did is we said, all right, what if we just dumped all this money into a single premium whole life insurance policy? Now let me take it back to pre-1988. Pre-1988, this is what the wealthy did. You see, back before the MEC rules existed, because those rules were put in place by the IRS in 1988, before that, these oil tycoons or anybody that had a bunch of money could take their chunk of money, dump it right into the insurance companies into a specially designed single premium whole life and be done. And that money would grow uninterrupted, it would compound, and they could use it tax-free. Up until 1988, it was like the best thing going. And then the IRS decided that they're going to say, well, hold on a second. This is just becoming a tax shield. This is becoming a way to just shield money from taxation. So they said, nope, we're going to put in place the MEC 7-pay rule, which prohibits somebody from dumping a chunk of money into a whole life policy and just being done because it would violate this 7-pay rule. So let me just put this up on the screen so you can see what I'm talking about. This is the modified endowment contract. These are the rules that were put in place. First, your cash value growth still remains tax deferred. This would be similar to kind of how an annuity would work. But the loans that you would take, they're not going to be taxable up to the amount of your cost basis, the amount of premiums that you put in. So in this example, if a person put $100,000 in premium deposits in one time, that's their basis. Okay, so we're going to pay tax on anything above and beyond that. So that includes taking loans. If you took a loan above and beyond the $100,000, it's still taxable in the event of your policy being what's called a MEC. Right, another thing to be very aware of is withdrawals before 59.5, they're going to be subject to a 10% penalty and incur income taxes to the extent of the gain. And withdrawals after 59.5 are still going to have income taxes in extent of any of the gains that you have, but the death benefit remains tax-free to the beneficiary. So that's what happens if a policy is MEC. Now, normally in all my teachings, if we're going to build a policy, we're going to build a policy that is not a MEC because we're going to follow the rules. But today, we're simply talking about that windfall of 100 grand, dumping it into a policy one time, that would create a MEC. So what could we do to alleviate or kind of get around that MEC rule. One of the things that we've done is we can take that $100,000 and we can put it into what's called a SPIA, a single premium immediate annuity, which basically means the insurance company is going to hold that 100 grand, but then what they're going to do is they're going to disperse that 100 grand every single year for a period of time or for your lifetime. So in this example, if we put $100,000 into a SPIA, the insurance company is going to pay us a payout rate, okay? And what that's going to mean is you're going to get yearly distributions of $11,546.62. Now, let me be very clear and give some transparency here. This is based on a male, 45 years old, 6 months prior to their last birthday. These things matter because the SPIA and the payout rate is all determined based on someone's age. So if this person was older, the payout's going to be more. If they were younger, the payout's going to be less. So please be aware, this is based on a 45-year-old male. If they put 100 grand in, it's going to produce $11,546.62 per year. But there's going to be taxes on that, on the gain portion of that. So that tax, based on a tax rate, which we just used, a 25% tax rate, is going to be $433.23, meaning you're going to basically have roughly $11,000 and change left, okay? So what we're going to do is we're going to take that $11,000 and change and put that into a 10-pay whole life policy that is designed and engineered the way we do it. So if you're looking at the screen, this is what it looks like. So you've got roughly $11,000 each year for 10 years going into the policy. So at the end of 10 years, your $100,000 that you put into that SPIA is now worth $124,072. Okay, that's not terrible. That would give you a projected cash-on-cash return that year of 138.66, roughly 38.66, but that's not the right way to look at this. So how I would look at the return, if you're looking at the screen, if we made $24,072 on our 100, but we also made money every single year because the SPIA had a payout rate. So that 100,000 actually gave us a little more than 11,000. So forget about the extra. Let's just talk about the 11,000. So 11,000 was put in this policy every year for 10 years. That means 110,000 was put into the policy over that time frame. But we made 24,000, so we would divide the 24,072 into the 110,000 to figure out what that rate was. So that's roughly going to be a 21% cumulative return, effectively 21%, not 24 like I said. I screwed up the math. So you got about 21.88%. But then if we wanted to figure out what that works out to be every year, you would divide that by the number of years. That was for 10 years. So you made roughly 2.18% each year that money went into the policy. Okay, so that's the math. Now, most of you are thinking 2.1%, that's terrible, but is it? Because every year you put that 11,000 in, you had access to use that money. So year one, you had access to roughly 73%. That's 8,105. So let's say you took that 8,000 bucks out of the policy as a loan and sent it to work at 12% or to pay off a credit card. Now you're making money twice. So it's not about just the return you make on the premium deposits and the cash value. It's also the return you could make, which I'm not going to show today, on the money that you could take out. Because remember, the specially designed whole life gives you the ability to not only make the interest rate and the dividends on the policy, but also to use that money and make money a second time, as long as the company that you're using offers non-direct recognition. I have other videos that show that. But let's keep moving on. So that's if we used the SPIA to fund the policy. Now here's the good news. By doing it this way, we avoid the MEC. There is no MEC here. This is all built within the MEC guidelines, so therefore all the money that grows is tax-free the way that you're looking at on the screen. Now, what I'm going to do next is now we're going to go and we're just going to dump the money into a single premium whole life. But before we do that, what I'd love to do is have a little pause and ask you to hit that little button right there. It says subscribe. That's right. Click that subscribe button, and while you're at it, there's a little bell up top. Yep, this is Wilson, so you don't ever want to hit Wilson when the glasses are on, so you drop the glasses and you smash that bell. Now, when you smash that bell, that's going to give you notification of all the videos that I put up there, and you're just going to be smarter just like Wilson is. So what we're going to talk about now is we're going to talk about a single premium policy, a single premium whole life policy. Now this is designed and engineered so that it has maximum cash value, but right here from the screen you can see this describes what it is. It's a one-time payment going in, but because it's a one-time payment, it is going to trigger a MEC. You're going to have immediate full coverage of the death benefit. You're going to have cash value accumulation like you would in a regular policy. It's going to grow tax deferred like we talked about. You're going to have access to the cash in either withdrawals or policy loans. The policy is not going to lapse because it's built just to accept money one time, and it's great for estate planning benefits or if you just wanted to earn potential dividends. So let's look at the numbers. So now you can see over on the right hand side, we put $100,000 into it. So that means all the money went to work immediately inside the policy, which is the best way to do it if you wanted immediate liquidity of that money. The gain at the 10th year, you made $42,071. So now if we did the math, we can do this pretty simply because you put 100 grand in and you made 42,000 over a 10-year period. So that's roughly a 42%, 42.01% cumulative return on your money divided by 10 years. So now you made 4.2% on your money. Now, the effective tax rate is 25% in this example, like I mentioned earlier. So that means on that $42,071 in gains, if you took it all out, you're going to pay taxes. At 25%, that's roughly $10,517. Because remember, this is a MEC. And also, there's a 10% penalty before 59.5. So your taxes and penalties are roughly $14,724. So your net benefit after taxes would be $128. So then what we would do is we would just divide that by 10. That'd give you roughly a 2.81% return. Now remember what that SPIA was? You notice how they're both very similar returns. But now this one, any future returns you're getting are taxable, and the other one, it was not, because we built it within the MEC rules. This one is a MEC from day one. So the interesting thing here is we just have to basically run the math to see which one makes more sense. This option would make more sense for somebody that wanted immediate liquidity of their money. The other one that we showed with the SPIA would be for somebody that's just looking to put the money away, doing it the most efficient way from a taxable standpoint, and provide a death benefit. Because that's the one thing we didn't talk about. The single premium whole life gave you a death benefit of $192. So your 100 had a legacy value of $192,779 from day one. If you did it with the SPIA and you had that money going to the policy every single year, which made the policy better from a tax efficiency, and you got a little bit more death benefit, which in year one, $203,618. So not too big of a difference. So when you compare the two, you can see there's not a huge difference between the two. It's just deciding whether or not you want to put the money into the policy all at once, pay the taxes, and get the net result is about the same, or if you wanted to do the other route where the money's working for you inside the annuity while it's paying out, and now all of a sudden you have almost the exact same result, but future dollars and future growth would be tax-free. So to wrap this whole thing up and give you some clarity on what we just went over, all we assumed is that somebody had a windfall of $100,000 and they wanted that money inadvertently to make it into the policy because they, number one, wanted to create a legacy, the death benefit, they wanted some tax efficiencies, and they wanted guaranteed growth of their money. And I think most of them would have wanted to have access to that money to use it to go make money a second time, which again, in today's video, we did not show it. We just showed two examples of the exact same scenario, one which was tax efficient, one which created a MEC, so it was taxable, but even netting out the taxes, they were both about the same. So really it comes down to a personal preference. Do you want all the liquidity right away? Well, then the single premium would be the choice. Or if you didn't and you could defer that money and just let it grow, the single premium annuity is a good option. Not saying any one of these are better than the other. It really comes down to the needs and the goals of the client. So at the end of the day, it really comes down to what your needs and goals are for that lump sum of money, that windfall that you got. So as we close this video out, there's another strategy that I'd love to teach you about, but I already made a video on this. So if you want to learn how to protect your retirement dollars using very similar strategies to what we just went through, but using retirement dollars to provide a volatility buffer so that when your 401k's value drops and you need to take an income, you don't disrupt the growth of your 401k, and you don't have to cripple the 401k by taking money out of a downward performing market. So this volatility buffer video that I'm going to show you right here is a great video to watch, especially if you're looking to bulletproof your retirement plan. Thanks for joining me. This has been another episode of BYOB. We'll see you on the next one.